Okay, let's talk about the next valuation model, which is the price to earnings ratio. So we may use this type of the ratios to evaluate the firm's stock price, whether this is mispriced or not, because this price is the market factor and the earnings are actually the objective, the factor that may standardize the market price. So we compare like the price per unit of the earnings, like net income, to see if there is possible misprice between the certain stock per the PE ratio is called per, and the industry average usually. If the per is too high, like the comparing with the industry average, it means that it may be overpriced. If per is too low comparing with the industry average, then it may mean that the stock price is underpriced. So based on that mispriced, you can make the recommendations. So this multiples the ratio of the stock price to earnings per share, EPS. This is EPS. So PE ratio equals to PPS divided by EPS. Okay, so let's see the determinants of the PE ratio. Now, we're starting from P0 equals to E1 divided by K plus present value of the growth opportunity, right? That's the formula we learned the previous slide. And then the PE ratio is simply we divide by E1 for both, right? Then PE ratio will be, now you have 1 over K plus PVGO divided by E1, right? If you factor out the 1 over K, which is the 1 over market capitalization rate, is basically times PVGO. Actually, it's actually 1 plus. So, see. So you factor out the K, 1 over K, then it's actually 1 plus PVGO divided by E1 divided by K, right? So this is actually the missed 1 plus. Okay, so we can see the determinants of the PE ratio based on this formula. So first of all, when PVGO equals to 0, it means the PE ratio is simply 1 over K, right? So PE ratio is constant for no growth one. Now, if the PVGO increase, present value of growth opportunity increase, then this factor increase, so your PE ratio increase. It means that if the firm has more growth opportunity, then the PE multiples actually growing. So high PE ratio has two meanings, two separate meanings. Number one, it may mean that the stock is overpriced, as I said. So if the stock is overpriced, it means that you have to sell the shares. Or it also can mean that this stock has more higher growth opportunity. So you have to differentiate between two. Now let's look at the examples in text. and we can see the examples of the textbook here. I'm going to use the ebook and to find ebooks. Ooh. To find examples. It takes a little bit more time. Okay. So chapter 13 and 5. So let's go to the P multiples. 13.4 and see the example 13.5 first of all. Now we have example 13.4 you may use in the previous one actually. So let's look at that example first. So that's the example 13.4 here. Okay. Okay. So the takeover target is run by intrinsic management that insists on reinvesting 60% of its earnings in projects that provides an ROE of 10%, despite the fact that the firm's capitalization rate is 15%. So the problem here is ROE is only 10% lower than K, which means that it may be unprofitable project. It may decrease the value of the firm. However, because of the management, you have to do, the firm's year-end dividends $2 per share and paid out of earnings of $5 per share. So earning is $5. At what price will the stock sell? What is the present value of the growth opportunity? Why would such a firm be a takeover target for another firm? So see, given current management investment policy, the growth rate here is what? Is 6%, right? And growth rate is 6%. Now, the stock price should be, so $2, which is the dividend, divided by K minus G, which is $20.22. Now, if you compute the present value of the growth opportunity, in fact, if you don't invest and pay out everything, it's actually 5 divided by 15%, which is $33.33. So you actually lose $11.11. So PVG is negative. It means that the net present value of the project is negative. So this is not good project. You basically invest unprofitable projects. So your price decreases. Your value decrease. This firm may be a good takeover target because simply, so you take you buy this firm and not investing in that project, then the stock price will grow to $33, right? So this price simply underpriced since this comes from the wrong management decision. So if you take the right decision, then you may have a good chance to have the profit $33.33. It's kind of the intrinsic value of the firm. So now let's look at the 13.5 example, PE ratio example. Okay. So 13.5. Yeah, here. So return again to takeover target. The firm refers to counter in 13.4. Earnings are $5 dollars per share, the capitalization rate is 15%, implying that the net growth value of the firm is $33.33, right? The stock price actually $22.22, implying the PVGO is negative $11.11, implying that PV ratio should be like here. You plug the number into the formula, it's 4.44, which is actually lower than it should be. So we can simply we can see this one is underpriced one. So underpriced one is good takeover target. Okay, PE ratio for firm growing long run sustainable pace. Now, so if you take these like the take into account this the B, which is this 1 minus B is the dividend payout ratio, right? Then let's look at the PE ratios. The formula again. The P0 equals to D1 divided by K minus G, right? Now where D1 equals to now earnings times the dividend payout ratio, right? And the growth rate is ROE times B. If you plug these two here and there, then your P0 equals to E1 times 1 minus B divided by K minus ROE times B, right? So PE ratio is now 1 minus B divided by K minus ROE times B, which is again 1 minus B minus K minus G. So from this example, we can see the relation between the plowback ratio and market capitalization rate and the growth rate and the PE ratio. Now, if the market cap rate increase, what happened? Your PE ratio decrease, right? If you retain more, so B increase, both increase, actually have two same signs, negative. So it depends on the if ROE is actually greater than K, then P increase. So if ROE is greater than K, P increase. If ROE is less than K, then P decrease. If ROE equals to K, then doesn't change, right? So to increase the ROE, we need to have the opportunity to invest in the high profitable, high growth projects. Now, there's a PEG ratio. That's the ratio of the PE multiple to earnings growth rate. So how to use the PEG ratio? Now let's look at the again example 13.6 here. So suppose risk-free rate is 8% and RM minus RF, which is the market risk premium, is 8%. That's kind of historical market risk premium. And B, which is the plowback ratio, the retention ratio is 40%. So that's the typical plowback ratio. 60% payout, 40% retain. Therefore, your market return should be RF 8%, the risk-free plus the risk premium, which is 16%. And it means that if you use the CAPM, then the average company which has the beta equals to 1 market risk, your market capitalization rate is also 16%. If we also accept the reasonable that ROE equal to 16%, which is basically the same as the K, we conclude that the growth rate around 6.4%, because ROE 16% times 0.4. So P, and if you plug this one, the P ratio will be 6.26, which means that generally, that's the overall condition. So generally, the P ratio and the growth rate is pretty like similar numbers. However, this sometimes doesn't work, you know. So suppose now, because of interest rate declines, you know, now the long-term treasury bond rate is about 3%. Then instead of using 8% as RF, we use the 3%. Then the RM, which is the market return, will be 11%, not 16%. Then everything changes. Now growth rate should be 4.4%, and if you use this one, P ratio will be 9.1. So you basically have the different numbers, right? So rule of thumb actually violated. And PEG ratio now is 9.1 divided by 4.4, which is like 9.1 is the PE. So PEG ratio usually close to 1, but now this is 2.1. So lower than PEG ratio, still widely seen as the signaling potential underpricing. So when you use the PEG ratio, you know, you basically believe that, oh, it's pretty close to 1 usually. If it is far from 1, now you can see that, oh, this may be widely underpriced one. So you can use the PEG ratio also, like along with the PE ratio, to see if the stock price is underpriced or overpriced. Now this is typical ROE pullback, you know. Okay. Now we see that. You see the PE ratio and inflation, there's a certain relation between two. So the problem is here, like this is the pitfall in PE analysis. Biggest problem is earnings management. So this earnings is counting earnings. So these earnings may be manipulated, not illegally manipulated by using just the US GAAP rule. So if you just call it earnings management, earnings management is not illegal. It's not illegal. It's not illegal. It's legal. So you follow the rule, but you use that rule to manage the earnings. So if discretion between the real earnings and the managing earning is large, then this ratio also is flawed, right? So that's the biggest problem you may have when you use the PE ratio. See, sometimes the PE ratios, you know, there's a big variation between the companies. So some PE ratio pretty stable, some PE ratio pretty volatile, you know. So we may see the volatility of earnings. So if the earnings are volatile, then the PE ratio is probably not very trustable. You know, see, this is PE ratios. So, and see, the last figure is the PE ratio by the industry. But industry is very, very different too. So we usually use industry average to compare with certain firms, you know, the individual firm, because the industry may play a critical role to determine the PE ratio too. We can also combine the PE ratio and the DDM model. So that's the example here. So one example. So suppose we expect that the next year dividend will be $1, and 2 years later $1.13, 3 years later $1.26, and 4 years later $1.40. And then we forecast that, well, forecast PE ratio of year 4 will be $15 times. That's forecasted, okay? And the EPS for is 2.7, so $2.70. Then this is the kinds of the dividends, and we can actually estimate the price using P equals to PE times EPS, earnings, right? Because the denominator is EPS and cancels out. So 50 times 2.7, which is $40.50, which means that now P4 is the 40.50. So P0 equals to D1, 1 divided by 1 plus, so suppose the K is like 12.6%. Okay, so 0.2126 plus D2, 1.126 square, D3, 1.126 to the third, and D4, 1.4 plus, now we sell it price, divide by 1.126 to the fourth, and it's going to be $28.73. So we can actually use the both PE analysis and the dividend discount model. There are other comparative valuation ratios, the price to book ratio, price to cash flow ratio, price to sales ratio. This is also very useful, but in many cases we usually use the PE ratio. However, these ratios are also very related to the PE ratio, especially price to cash flow ratio, price to sales ratio. They generally move together. Price to book ratio now can be used to see how much value is created by from the cost of the equity, which means that if you have high P price to book ratio, then you create more values. So if you look at this, another P and the price to sales and the price to cash flow is generally move together. So sometimes we can simply use the price to sales instead of PE, because sometimes earnings are negative and sales never been negative. So especially the firm is a starting firm, the earnings are very volatile, then sales is probably more stable. Then we can use the ratio instead of PE.